A 74-year-old woman walked into her local bank last spring to take out her own money. The bank refused, and not because the funds weren't there, but because of a regulation that 7 federal agencies quietly approved in 2024. And almost no one over the age of 60 has been informed it even exists. I'm going to share exactly what happened to her in just a few minutes. But first, I need to walk you through some background, because the conclusion of this story is going to matter. And I want you to have the full picture before we get there. I'm Nancy, and this is Senior USA Hub. Last month, I released a video about the $10,000 bank rule. More than 200,000 of you watched it. Since then, I've seen a wave of other channels publish their own takes on the same subject. Some are solid, some are dangerously inaccurate. I watched one recently that described a retired couple receiving a letter from the government. A letter that federal law makes it a criminal offense for any bank to send. I'll return to that one shortly as well. But here's the piece I need you to understand first, because everything else in this video only makes sense once you hear it. The $10,000 threshold has not moved since 1970. Back then, $10,000 was more than most Americans brought home in an entire year of work. That amount could buy you 2 brand new Cadillacs. Gas was 36 cents per gallon. A house cost around $23,000. That was the world this regulation was designed for. Drug traffickers hauling suitcases stuffed with cash. Not a retired school teacher selling her late husband's pickup truck. That number has never once been updated, not a single time. Last year, the Government Accountability Office, the federal government's own independent watchdog, reported that if Congress had tied the threshold to inflation the same way they adjust Social Security, it would sit closer to $73,000 today. Instead, it's still $10,000, which means that back in 1970, the rule targeted criminals. In 2026, it catches your grandmother paying a roofing contractor. I'm not saying that to alarm you. I'm saying it because everything I'm about to cover only makes sense once you see that picture clearly. The rule is old. The world around it has changed beyond recognition. And that gap is why things keep getting stranger for retirees standing at the bank counter. All right, a quick summary for anyone who missed the first video. The $10,000 rule states that any cash transaction exceeding that amount in a single day triggers an automatic report called a currency transaction report. The bank files it. It goes to FinCEN, which is a bureau inside the Treasury Department, not the IRS. The report is automatic. Banks file millions of them. The report on its own means nothing. The problem, as I covered last time, is structuring. Breaking up a deposit to stay beneath the threshold is a federal offense, even if your money is completely legitimate. If you didn't catch that first video, the link is below. Watch it after this one. Here's what I want to cover today. 3 things have quietly shifted since I made that first video. I'm going to walk you through each one. Then I'm going to correct 3 pieces of misinformation I've watched circulate this month, because any one of them could lead you to do exactly the wrong thing. Let's get into it. Change number 1. Your bank can now place a hold on your own withdrawal. In December 2024, 7 federal agencies, the FDIC, the Federal Reserve, the CFPB, the OCC, the National Credit Union Administration, FinCEN, and state regulators, issued a joint guidance statement. That statement directed banks that they are encouraged to place holds on transactions when they have reason to believe an older adult is being financially exploited. Depending on your state, that hold can last anywhere from 15 days to 45 days. Florida's law allows up to 45. Georgia and Kansas allow up to 25 business days. Other states have their own individual rules. And here's why this matters. More than $27 billion in suspicious activity connected to elder financial exploitation moved through the banking system in a single year, according to FinCEN's own data. The holds are intended to stop scammers from draining accounts belonging to seniors. That's the positive version of this story. Now let me share the story I mentioned at the beginning. I'm going to refer to her as Margaret. Margaret isn't one specific individual. She's a composite built from situations I've come across, assembled so you can recognize the overall pattern clearly. Last spring, a storm came through her area and tore up part of her roof. A contractor showed up at her door a few days later, inspected the damage, and said he could handle the repair for $18,000 in cash. Margaret had the money. She'd been setting it aside for years. She went to her bank to withdraw it. The teller called the branch manager over. The manager brought Margaret into a private office and began asking her questions. Who was this contractor? How did you connect with him? Has he visited your home before? Did he specifically ask to be paid in cash? And then the manager told her, I'm sorry, ma'am, but under our updated procedures, we're going to place a hold on this withdrawal for 15 days while we look into this. Margaret was furious, and honestly, that reaction makes complete sense. She kept saying, this is my money. I earned it. I need it now. And every word of that was true. Here's where the story takes a turn. About a year before any of this happened, when Margaret opened a new certificate of deposit at her bank, an employee had asked whether she'd like to add a trusted contact to her account. She named her son. Just a name and a phone number on a single form. 5 minutes of her time. Most seniors don't even know that form is available. During the 15-day hold, the bank reached out to her son. He asked a few questions, and within 20 minutes, it was evident that the contractor had changed his price 3 separate times, had no business license anyone in the family could locate, and had told Margaret he only accepted cash because the IRS was after him. It was a scam. The roof wasn't even damaged the way he had claimed. Margaret would have handed $18,000 to a man she would never see again. The hold stopped it. Her son stepped in. She kept every dollar, but I want you to consider the other version of that story. The version where the contractor was completely legitimate, where Margaret was simply trying to pay for real work on her real roof, and the bank held her money for 15 days with no trusted contact on file to help resolve it quickly. That version is happening to retirees somewhere across this country every single day. The difference between those two outcomes is one form, one name, one phone number. We're going to return to that form. Keep it in mind. Change number 2, Venmo, Zelle, PayPal, Cash App. A solid third of the messages I received after my first video were some version of this. I heard the IRS is now monitoring every payment over $600 on Venmo, so I stopped sending my grandkids' birthday money. Listen to me carefully. That is incorrect, and I don't want anyone cutting off support to family because of something they saw in a YouTube thumbnail. Here's what actually took place. For several years, there was a proposal to lower the reporting threshold on these platforms down to $600. That proposal was repeatedly delayed. Then in 2025, Congress passed legislation called the One Big Beautiful Bill Act that reversed it entirely for 2025 and every year going forward. Venmo, PayPal, and Cash App only report to the IRS if you receive more than $20,000 and complete more than 200 transactions in a year, and only for payments categorized as business-related. Personal payments between family members and friends are not reported as income on those forms. Zelle doesn't send those forms at all because it operates on direct bank-to-bank transfers. It's not a third-party payment processor the way the others are. So if you send your granddaughter $300 for her birthday, that is not appearing on any IRS income record. If your son sends you $5,000 through Venmo to help cover a medical bill and marks it as personal, that's not on any IRS income record either. Keep supporting your family. The $600 rule never went into effect. I know that's a lot to take in. Stay with me. The protective steps at the end of this video are the things you can actually put into action this week, and they tie all of this together. Change number 3, the pattern detection software inside your bank became significantly more sophisticated. And this is the one that's costing everyday people real money. Not because of any new law, but because of software upgrades that almost nobody is discussing. Let me tell you about Terry DeSico. Terry owned a small grocery store in Fraser, Michigan, and ran it for 3 decades. He was in his 70s. In 2013, the IRS seized roughly $35,000 from his business bank account, not because he had done anything illegal, but because his deposit pattern resembled structuring to their software. Terry had an insurance policy that capped cash coverage at $10,000. So he deposited below that limit. An algorithm flagged it. The government took his money. It took 2 years of legal effort and support from a public interest law firm, called the Institute for Justice to recover it. Terry's situation is not unusual. A 2017 audit by the Treasury Inspector General examined structuring seizures and found that in the vast majority of cases reviewed, more than 9 out of 10, the money involved had been legally earned. These weren't criminals. They were grocery store owners, dairy farmers, small business operators, and retirees whose deposit patterns matched a shape on a computer screen. Here's why this matters in 2026. The software is considerably more advanced now than it was when Terry was caught. It identifies smaller patterns. It cross-references activity across branches. The legal threshold is still $10,000. That hasn't changed. But the bank's internal monitoring system is paying close attention to amounts well beneath that number, which means the advice that used to seem reasonable, just stay under the limit, is the exact approach that will get your account flagged today. All right? 3 things that changed. Now let me correct 3 things that are being misrepresented online, because I've watched all 3 of these spread this month. Myth 1. The threshold dropped to $7,000. No. The law still says $10,000. A bank's internal software may flag patterns at lower amounts, but the reporting threshold written into the statute has not been changed since 1970. Myth 2. Your bank is going to send you a letter informing you that a suspicious activity report was filed on your account. This is the significant one, and this is the falsehood I mentioned at the start of this video. Federal law, specifically Title 31 of the United States Code, Section 5318, makes it a criminal offense for any bank employee to disclose to a customer that a suspicious activity report has been filed. A bank employee who does that is personally violating federal law. So when you see a video describing a retired couple receiving that letter in the mail, that story cannot be accurate. What you might actually receive is something entirely different. A source of funds letter, which is a standard request for supporting documents. You respond with your paperwork. The matter is resolved. It's a completely different thing. Myth 3, if you're over 65, the government is scrutinizing your account more intensely than everyone else's. That one isn't accurate either. The Elder Protection Guidance is designed to shield you from scammers, not to place you under surveillance. The additional attention on senior accounts is aimed at keeping predators away from your money. And if you use the form I'm about to describe, you're the one directing that protection, not the bank. Which brings me back to that form I keep referencing. This is the single most important thing I will share in this entire video. Go to your bank this week. Ask for the Trusted Contact Designation form. Don't call it a Senior Safe Banking Authorization. I've seen that term circulating online, and it does not correspond to any real banking product at any major U.S. bank. Someone invented that name. The correct term is Trusted Contact Designation. Every major bank provides it at no cost. You complete it once. You write down the name and phone number of one person you trust, typically an adult child, a sibling, or a longtime close friend. That person does not gain access to your funds. They cannot sign anything. They cannot view your balance. What they can do is answer the phone when your bank calls, and that one phone call is what transforms a 15-day hold into a 20-minute conversation. Here's the four-word summary of everything covered today. State your purpose at the counter when making a large transaction. Never split deposits. Submit your documentation the same day. Add a trusted contact to every account you own. State, avoid, file, elect. That's the entire plan. One final thought before I wrap up, and I want to close on this because I think you deserve to hear it. In October of 2025, a bill was introduced in Congress called the Streamline Act. If it passes, it would raise the $10,000 reporting threshold to $30,000 and require the Treasury to adjust it for inflation every 5 years going forward. I don't know whether it will pass. I've been let down before. But I want you to know the conversation in Washington is finally beginning to move in the right direction. The rule written in 1970 might actually be updated for the world we're living in now. If that happens, I'll be the first to tell you. Look, you spent your entire working life building this money. You raised a family with it. You saved it through decades when saving wasn't easy. You shouldn't need an attorney just to move it around. You shouldn't feel anxious walking into your own bank. You simply need to know what almost nobody is telling seniors right now, and now you do. Leave a comment before you go. Tell me your state. Tell me the biggest transaction you're concerned about right now. I don't have a team reading these. I personally read every single one. The situations that come up most frequently in the comments are the ones that shape the next video. If your situation is a bit complicated, if you're uncertain how any of this applies to what's happening in your life right now, put it in the comments. Someone else is probably dealing with the exact same question and doesn't know how to bring it up. You might be the one who opens the door for them. The next video I'm working on is a breakdown of the exact source of funds letter your bank sends when they need an explanation, line by line, in plain language. So if one of those letters ever arrives in your mailbox, you already understand what it says before you even open it. If you know one person over 60 who moves significant money through their account, a parent, a spouse, a neighbor, a friend, please share this video with them. That trusted contact form might be the most valuable 5 minutes they invest this entire year. I'm Nancy. This is Senior USA Hub. I'll see you in the next one. And please subscribe my channel for more valuable content.